Let's have an honest conversation. If you're around 40 years old, you are probably feeling a unique kind of pressure that nobody really warns you about when you're younger. You are right in the middle of what people call the sandwich years. You might be looking at your kids' upcoming college tuition, managing a mortgage that still has 20 years left on it, and quietly worrying about your parents as they age. At the same time, you look at your retirement account, and instead of feeling secure, you feel a tightening in your chest. Maybe you feel like you started too late. You've worked hard for 20 years, but when you look at your bank balance, it feels like you have been pouring water into a bucket with holes in the bottom. It is not that you haven't earned money. You've earned plenty of it over your career. But somehow, between life's daily demands, bills, and unexpected emergencies, the money just seems to slip away. I want to tell you something very clearly. It is not too late. You still have a solid 25-year runway before retirement. But the financial strategies you were taught when you were 20, like saving your money in a traditional bank and hoping for the best, are actively keeping you stuck. Today, we are going to break down how a simple, automated snowball habit can plug the leaks in your bucket, use the natural biology of money to make your savings reproduce, and secure your financial future. No hype, no complicated jargon, and no get-rich-quick scams. Just honest math, human psychology, and a step-by-step roadmap designed for your life. Welcome back to Teddy's Wealthcraft, the place where we help everyday Americans think smarter, protect their hard-earned money, and see the hidden opportunities that others miss. If you are ready to take back control of your financial destiny and gain an unfair advantage in your golden years, make sure to hit that like button and follow the channel. The final mathematical shift we reveal later in this video will completely change how you view your bank account, so you will want to pay close attention to every step as we build the momentum. Let us start with a hard truth that the giant banking institutions desperately hope you never figure out. Keeping your money sitting safely in a traditional bank account is actually making you poorer by the second. We have been conditioned for decades to believe that a local savings account is the ultimate shield of safety. You walk into a beautifully built brick-and-mortar bank with marble floors, you make your deposit, and you sleep easy, thinking your cash is quietly growing. But let us look at the cold, hard math. The average traditional savings account interest rate in the United States is hovering at a pathetic 0.39%. At the same time, inflation has been running between 3 and 3.5%. Let us do some simple math so you can see the invisible leak in your bucket. If you keep $10,000 in a standard savings account, the bank might pay you a measly $39 in interest over the course of an entire year. Meanwhile, inflation quietly raises the cost of your groceries, your utilities, and your healthcare by over $300. You technically have more paper bills, but your actual purchasing power has shrunk by hundreds of dollars. You are paying a quiet tax on your safety. And what is the bank doing with your hard-earned deposit while you lose ground? They do not let it sit in a vault. By law, they only have to keep a tiny fraction of your money on reserve. They take the rest and immediately lend it out to other people at much higher interest rates, sometimes charging up to 20% or more on credit cards. They are using your money to make massive profits that you will never see. At age 40, you cannot afford to let your savings be chewed up by inflation disguised as security. To win the game from here, you must stop being a spectator and start understanding how money actually grows. To break out of this cycle, you have to completely shift how you look at a dollar bill. Most of us view money as a token we trade for things, a car, a meal, a vacation. But wealthy people look at money through a biological lens. Every single dollar you own is a living seed with the potential to grow an entire tree. Or to put it even more simply, every dollar is an employee that can breed and have babies. When you spend $1 on something temporary, you are not just spending $1. You are killing a seed that had the potential to grow an entire tree of future income. But when you put $1 into a compounding asset, that dollar goes to work. Over time, it earns an interest payment or a dividend. That dividend is your dollar's first baby. Now, instead of one worker, you have two. If you reinvest that dividend back into the engine, those baby dollars grow up and start having their own babies.
This is the essence of compound interest. It starts out incredibly slow. In the first few years, it feels pointless. You look at your account and maybe you have only made a couple of $100 in returns. It is easy to get frustrated, assume the system does not work, and pull your money out.
But compounding is not a straight, predictable line. It is an exponential curve. Think of a tiny snowball at the top of a long hill. When you first push it, it barely picks up any snow. It looks ridiculous, and you might think it is a waste of time. But as it keeps rolling, it gains mass. Soon, the new layers of snow are grabbing even larger layers. By the time it reaches the bottom, it has turned into an unstoppable avalanche. As someone in your 40s, you do not need a 40-year hill to make this work. You have a 20 to 25-year hill before you retire. That is more than enough space for a disciplined snowball to completely transform your retirement security. Because you are starting in your 40s, you do not have the luxury of wasting 10 years on trial and error. You need a structured, battle-tested framework that balances safety with growth. This is the 7531 rule, designed specifically to give you clarity and control over your compounding journey. The first number, 7, is the minimum time commitment you must make to your investment pool. Why 7 years? Because 7 years is the threshold where short-term market chaos gets smoothed out by historical reality. If you invest your money in the broad stock market for just one single year, you have about a 74% chance of making a profit, meaning you have a 1 in 4 chance of losing money if you have to pull it out. But if you look at every rolling 7-year period in the history of the S&P 500, going back to 1926, the average annual return was positive in every single one. There are absolutely no exceptions. 7 years is the magic number, where the math stops being a scary theory and starts being a visible, historical certainty. When you commit to a 7-year horizon, your brain stops treating your investments like a daily scratch-off ticket. You stop panicking over the daily news headlines, and you start treating your money like a tree you are planting for your future. The second number, 5, represents the 5 layers of diversification. At age 40, you cannot afford to gamble your nest egg on a single hot stock, a speculative cryptocurrency, or a friend's business idea. True diversification means spreading your money across 5 distinct layers that do not all move in the same direction at the same time. The first layer is broad market index funds. This is your foundation. By owning an index fund that tracks the S&P 500 or the total stock market, you instantly own a tiny piece of hundreds of the most profitable companies in America. Historically, this layer has returned about 9 to 10% per year over the long term. The second layer is dividend-paying stocks or funds. These are companies that not only grow in value, but also pay you cash regularly. Reinvesting these dividends acts as an automatic accelerator, buying you more shares, which then pay you more dividends. Research suggests that dividends have accounted for roughly 40% of the market's total return since 1930. When the market goes sideways, dividends keep compounding quietly in the background. The third layer is small and mid-cap growth stocks. These are smaller companies with more room to grow, but they are also more volatile. Historically, small-cap stocks have outperformed large-cap stocks over the long haul. From 1926 to 2024, small-cap value stocks returned an average of over 14% per year, compared to around 10% for the broad market. That extra return sounds small, but on a $10,000 investment over 30 years, it is the difference between ending up with $180,000 and over $560,000. Keep this layer at 10 to 20%. The fourth layer is international exposure. The United States represents only a portion of the global economy, making up less than 60% of total global stock market value. Holding international funds protects you from being entirely dependent on a single country's economic cycle. The fifth layer is defensive assets. This is your anchor, like bonds, treasury bills, or high-yield savings accounts. When the stock market drops 30%, defensive assets stay relatively flat or provide a cushion, protecting you from the single biggest wealth destroyer, which is panic selling. Portfolios diversified across these asset classes have about 20% less volatility than concentrated portfolios, meaning fewer panic moments. The third number, 3, represents the emotional storm you must brace yourself to survive. Building wealth is less about intellect and far more about managing your own behavior. As you start this journey, you are guaranteed to hit 3 distinct emotional walls. Phase 1 is doubt. This happens in the first 2 years. You are putting money away consistently, but your balance looks small. You see others taking flashy vacations or buying new cars, and you start wondering if you are being a fool. Trust the process, because the roots of your tree are growing deep beneath the soil. Phase 2 is frustration. This kicks in around year 3 or 4. You have invested thousands of dollars, but the returns still feel linear rather than explosive. This is the danger zone, where many people pull their money out to buy something temporary, turning off the oven right before the cake is fully baked. Phase 3 is panic. The stock market will drop. When your portfolio turns red, fear will scream at you to sell and protect what you have left. But history is clear. Every single market crash in American history has been followed by a complete recovery and new all-time highs. Selling locks in your losses, while holding guarantees you ride the elevator back up. The final number in our rule is 1. Just one single adjustment once a year. Increase your monthly investment contribution by 5%. If you are currently investing $300 a month, a 5% increase is just $15 more per month in year 2. That is the price of skipping one takeout meal or a couple of premium coffees. But mathematically, over 20 to 30 years, that tiny annual increase will nearly double your final nest egg. It keeps your savings habit growing as your income naturally grows, without putting a painful strain on your daily budget. Investors who increase contributions by even 1% per year end up with 25% more wealth over 20 years compared to those who keep contributions flat. Let us talk about a silent mistake that quietly ruins compounding engines, even for people who do everything else right. It is called portfolio drift. Imagine you set up your ideal, safe portfolio, 70% in stocks and 30% in bonds. That was the risk level you decided was comfortable for your family. But then the stock market has a fantastic year, while bonds return almost nothing. Without you making a single decision, your portfolio split has now drifted to 80% stocks and 20% bonds. Your portfolio has quietly become much riskier than you ever intended. If a sudden market crash hits tomorrow, you will take a far bigger hit than your financial plan allowed for. To keep your compounding engine running cleanly, you must practice a simple monthly and annual habit. First is the monthly check-in. Look at your actual percentages. If stocks have run too high, do not sell them, because that can trigger taxes. Instead, simply direct your new monthly contributions into your underweight assets, like bonds or international funds, until the balance naturally restores itself. This is called contribution-based rebalancing, and it forces you to systematically buy low without any emotional guesswork. Second is the annual hard rebalance. Once a year, put a date on your calendar to reset your portfolio back to its target. If stocks are up, you sell a tiny portion of those high-performing stocks and buy the underperforming, cheaper assets. It goes against human instinct to sell what is working and buy what is not, but it is the only disciplined, mechanical way to ensure you are always selling high and buying low. It is incredibly easy to look at a 6-figure retirement goal and feel defeated before you even start. But wealth is not built in giant, heroic leaps. It is built through small, boring daily habits repeated with uncommon consistency. Take the story of a cashier who decided to track every single dime she spent for a month. She realized that quick, impulsive snack runs were draining $150 a month from her budget. She made one adjustment.
She started packing her own lunches and automated that $150 straight into a simple, low-cost index fund. 10 years later, those homemade sandwiches had compounded into more than $25,000. She did not need a massive salary, a finance degree, or luck. She just needed a small snowball, a hill, and the discipline to keep her hands off the gears. If you are in your 40s, the worst thing you can do right now is wait for a miracle, wait for the perfect time to start, or let fear keep you frozen on the sidelines. Every year you delay is a year of potential growth that is gone forever. Before the clock steals another hour of your day, take one small, concrete action to prove to yourself that you are taking control of your future. Calculate your real net worth, which is everything you own minus everything you owe. Cancel one forgotten subscription that is quietly bleeding your account. Or open a basic tax-advantaged account, like a Roth IRA, which allows you to contribute up to $7,000 a year in 2026 and $8,000 once you hit age 50. And set up an automatic transfer of just $10 or $20 a week. Your retirement is not a distant, abstract myth anymore. It is a reality that is heading your way. But with 25 years left on your clock, the math is still completely on your side. Set your snowball in motion today and let time do the heavy lifting. What is the one minor daily expense in your budget that you could easily convert into a dollar soldier starting this week? Share your thoughts in the comments below. If this conversation brought you a sense of clarity and peace of mind today, please leave a like and follow Teddy's Wealthcraft so we can continue helping you think smarter about your money, avoid the banking traps, and see the financial opportunities that others miss. If you want to make sure your compounding engine never stalls during a market downturn, check out our next guide on how to protect your portfolio before the next crash hits.